Let's talk about credit memos, an unsung hero in the world of accounting. Now, I know what you might be thinking. Credit memos. Sounds boring. But hang on. These little documents are more important than you might realize. They're like the behind the scenes crew of a blockbuster movie, essential yet often overlooked. So, let's dive into what credit memos are, why they matter, and how they can make a world of difference in your business. First off, what exactly is a credit memo? Picture this: you've just bought a fancy new gadget, but when it arrives, it's not quite what you expected. Maybe it's defective, or perhaps you ordered the wrong color. So you decide to return it. When you send that gadget back, the seller issues a credit memo. This document essentially says, hey, we're giving you back some of your money because you returned that item. It's like a polite way of saying, we understand, things happen, and we're here to make it right. A credit memo isn't just a random piece of paper, it's a crucial component of the accounting process. It serves to reduce the amount of money owed by the buyer for goods or services they've purchased. The seller will include their name, the buyer's name, a description of the items being credited, and the reason for the credit. It's all about keeping things transparent and organized. In a world where invoices can get complicated, a credit memo is a breath of fresh air. Now, let's break down why credit memos are so important. First, they help maintain accurate accounts receivable records. When a buyer returns something, the seller needs to adjust their financial records to reflect that change. If they don't, it's like trying to fit a square peg in a round hole, it just doesn't work. By issuing a credit memo, both parties can keep their financial records straight, ensuring that there are no discrepancies down the line. And speaking of discrepancies, credit memos play a vital role in preventing disputes. Imagine a scenario where a customer believes they're owed a refund, but the seller has no record of it. That's a recipe for frustration, right? By having a well-documented credit memo, both parties have a clear reference point, making it easier to resolve any issues that may arise. It's like having a safety net in the world of business transactions. Now, let's talk about the different types of credit memo transactions. There are several scenarios where a credit memo comes into play. For instance, if a customer returns an item, that's a classic case for issuing a credit memo. But it doesn't stop there. If there's an overpayment, or perhaps a mistake on an invoice, a credit memo can help rectify those situations too. It's all about flexibility and ensuring that both buyers and sellers can navigate the sometimes murky waters of financial transactions. You might be wondering how credit memos affect financial statements. Well, here's the deal. When a credit memo is issued, it reduces the accounts receivable on the seller's balance sheet. This means that the seller is acknowledging that they won't be receiving that amount of money anymore. Conversely, for the buyer, it's a sweet deal because it essentially lowers their expenses. In the grand scheme of things, this can have a positive impact on cash flow, which is crucial for any business. Now, let's shift gears a bit and talk about tracking credit memos in the general ledger. This is where things can get a little tricky. It's essential for businesses to have a robust system in place to track these documents accurately. After all, if you're issuing credit memos left and right without keeping proper records, it can lead to chaos. A good practice is to maintain a dedicated account for credit memos in your general ledger. This way, you can easily monitor the credits being issued and ensure that everything is accounted for. But wait, there's more. Credit memos can also be a tool for building customer loyalty. When a seller issues a credit memo, it shows that they value their customers and are willing to make things right if something goes wrong. This can go a long way in fostering positive relationships. Customers appreciate good service, and when they see that a business is willing to issue a credit memo, it can enhance their trust and loyalty. Now, let's address some common misconceptions about credit memos. First, many people think that a credit memo reduces the total amount owed. That's not quite right. A credit memo documents a return or an adjustment, but it doesn't eliminate the original obligation. The buyer is still responsible for any remaining balance. It's crucial to understand this distinction to avoid confusion down the line. Another misconception is that credit memos automatically issue refunds. Not true. A credit memo indicates that a credit has been applied, but it doesn't guarantee that money will be returned to the customer right away. Sometimes, businesses may apply that credit to future purchases instead. So, if you're expecting a check in the mail, you might want to double check the company's refund policy first. And let's not forget about the difference between credit memos and invoice credits. They're not the same thing. A credit memo is a formal document issued to acknowledge a credit, while an invoice credit is an adjustment made to an existing invoice. Knowing the difference can save you a lot of headaches when it comes to accounting. So, when should you issue a credit memo? There are several scenarios where it's appropriate. If a customer returns an item, that's a no-brainer. But it can also apply when there's an overpayment, an error in pricing, or if a service wasn't fulfilled as promised. It's all about ensuring that your financial records accurately reflect the transactions that have taken place. Now, let's talk about the components of a credit memo. It's not just a blank piece of paper. There are specific elements that need to be included for it to be valid. First, you need identification information for both parties involved. This includes names, addresses, and contact details. Next, clearly state the reason for the credit. Whether it's a return, an overpayment, or a pricing error, transparency is key. The credit amount needs to be clearly indicated, along with any relevant invoice numbers. And let's not forget signatures. Both parties should sign the document to acknowledge the transaction. This adds an extra layer of legitimacy and accountability. In conclusion, credit memos may seem like small, mundane documents, but they play a significant role in the world of accounting. They help maintain accurate records, prevent disputes, and even foster customer loyalty. By understanding what credit memos are and how they work, businesses can ensure their financial health and keep their customers happy. So, the next time you hear the term credit memo, remember that it's not just a piece of paper, it's a vital part of the financial ecosystem.